Hello and welcome. Chris, thanks for joining us today.
Morning, Tim. How are you doing today?
I'm doing great. I want to welcome all of you and thank you for taking the time out of your day to spend with me and Chris at the Back to Business webinars, where we're going to talk about succession solved, and which we believe and have always believed is a very important topic for a business owner. And today we're going to dive into several pieces related to succession, and hopefully can set you up for success. And to kick it off, Chris, why don't you tell us a little bit about you and your background and what Foresight does?
Sure. Thanks very much, Tim. And Tim, I want to thank you, Live Oak, and certainly ICCFA for the opportunity today. So this series is great, and humbled to have the opportunity to be here. So thank you very much.
Absolutely.
So me personally, I've been in the profession for approaching 30 years. A lot of that with Service Corporation International. About the last 15 years or so have been away from SCI, more on the private side. I've been with the Foresight companies now for a little over 4 years. But the Foresight companies, we are almost a 40-year-old company. We are a consulting company just focused on the funeral and cemetery profession. So what we really do is we partner with funeral home and cemetery operators in helping them and putting some accountability and some strategic consulting around what they do. But the main thrust of what we do is around succession planning. And that is really gearing people up for success and helping them transition their business, whether that be selling it to a third party or to an individual family member or employee. So we focus a lot on helping people in transaction advisory. So helping people buy and sell funeral homes and cemeteries. So that's why we work together with you quite a bit.
Absolutely.
But, the Foresight companies, we are located here in Phoenix. But just to give you a little bit of the idea of the magnitude of what's going on in the profession today. Last year, we were at the Foresight companies. We were fortunate to be involved in 32 succession planning transactions, so the transition, which represented more than $300 million of enterprise value. So there's a lot of activity in this space. You all certainly know it. You all have been kind of leading the way in SBA lending and now conventional and other products as well. So yeah, it's been a real busy time in this space. The Foresight companies, we are totally committed to helping as many of you all in transitioning your business successfully as possible.
Well, we certainly appreciate the partnership with you here at Live Oak. Consider you a friend, respect your experience and your insights, and glad you're here. I do want to give a shout out to Tim Schramm. Tim Schramm was going to be with us. Tim Schramm is a funeral home owner and a customer of Live Oak out of Michigan, and is heavily involved with the MFDA, Michigan Funeral Directors Association Board. And he's not with us because he's actually in Maui with a team helping support some of the families and some of their needs there. So a huge shout out to Tim. Our thoughts and prayers are with you, and obviously with all the family members that are struggling in Maui. So hopefully we'll get to have Tim on this in the future. But I'm sure Tim would love to talk with you once he gets back. If you have questions, we'll send Tim's information out to you as well. So I'm Tim with Live Oak Bank. As Chris mentioned, we really primarily focused for years on SBA lending, and we've added to that fold with some conventional financing and deposits and some other really cool products that allow for smaller dollar financing in addition to larger dollar financing. And we're really trying to solve all the financing needs of the funeral home and cemetery. And we want to be your one-stop shop when it comes to really all of your banking needs. And that's really where we're headed. That's where we are today, and we're excited. But we could not do it without partnerships like with Chris and his team, because we're not consultants, and we don't really have the resources and the time to do the early succession planning. But we typically get involved at the tail end of that process and really build a bridge to get you the financing to make it happen. So today we're going to talk about all that stuff. And I think what's really cool about having me and Chris share our perspectives is we're on both sides of the transaction. Chris sees it pretty early and deals with a lot of back and forth early, and then I get to come in and be on the other side of it and represent a lot of the buyers who are trying to buy the businesses that Chris has teed up, and vice versa. So with that being said, Chris, I'd love to start with hearing from you what you see as some of the major challenges and risks related to succession planning, whether it's not doing it and the risk associated with getting prepared for it. Like there's some things there. What's some of your thoughts?
God, the risks of not doing it are significant. You know, just in the simplest terms, I would say it's not unrealistic to think that the outcome of a well-planned succession versus not is upwards of 20% or more in value, depending upon the timeline and what somebody's looking to do. But you know, when there isn't preparation for the next generation who's going to take on the business, it leaves a pretty considerable void. Right? We're finding situations where there may not be any buyers at all. And I think that's the greatest risk of all today, is in a scenario where there is no plan, or there is not somebody to step in a scenario where there is a tragic event. There's a scenario where that business ultimately has to be shut down and sold for real estate. I mean, that's the catastrophic. That's worst case scenario, right? No plan. You know, or equally as bad, you have a very poor tax structure that is going to, whatever the purchase price is going to be, you're going to be paying an extraordinarily high percentage of that to Uncle Sam. So again, poor planning takes away your options. If you plan with a little bit of runway, certainly with the products that the SBA and what you have available, there's plenty of options. There's a lot of different things. There's a lot of value creation opportunities. But the worst case scenario is no options at all.
Yeah, you brought up a good point. And it was actually a note I had related to planning. You know, I think as a business owner, you really have to think about your future personal goals, right? Because in this business, sure, we're taking care of families and we're trying to make a living, but we're also needing to think about the future and retirement. Because when we're thinking about succession, we're talking about retirement. I mean, this year we've seen quite a few sellers back out of the transaction because they realized that their retirement funds were not adequate.
Yeah.
So I think
we've all ridden high for the last 3 or 4 years, or not 4 years. I mean, listen, it's been very difficult times, but times in general have been pretty good, right? Yeah. So everybody's thinking things are looking all rosy, and it's going to continue to be rainbows and unicorns. But we now know that to be a little bit different right now, don't we?
That's right. Yeah, and I think that, you know, when you're, you know, young in your business, I think it's perfectly acceptable to think about your retirement goal and manage your business to that goal, you know. And I think without a plan and a goal in mind, you cannot achieve that. So to say that you need to wait to contact people like me and Chris until you're a year or 2 years out from succession, that is false. You know, you need to really talk to an expert years in advance so you can start thinking about and realizing what you're not thinking about, right? And that's the biggest thing. And you can back into your goals. And then in my opinion, if you're running your business with that goal in mind, you're running the business to achieve the value you want in the future. And you're going to have a healthier outcome and a great experience. So, you know, again, when you talk about going into a transition of a business without planning, there are always going to be surprises, and more times than none, what you're getting for your business is probably going to be a little bit less than what you expected. And I think you should at least plan that way. And I think the outcome, the goal of the outcome, and the goal, I know what Chris and his team are doing is to try to make that not happen. The reality is, I think the planning is probably the number one key here in getting pretty active.
Yeah, and you know, Tim, I think you're right. One of the keys is it is never too early to be prepared.
Right.
I mean, the unfortunate reality is we just conducted some research, and we know that over the next 5 years, Tim, almost 50% of all owners are going to want to transfer their business. They want to retire. So depending upon the numbers you're looking at somewhere between 7,000 and 10,000 firms that may change hands. I mean, that is a huge number. I mean, and you talk about the resources that you provide. I mean, that's a key part of this, and being prepared and providing that runway for somebody to potentially step in is a big part of it going forward.
Yes.
I think but you know, and one of the things you said a key thing a moment ago, and preparation really is about being organized. It's about having command of your business.
Yeah.
And I think the preparation and being prepared. Somebody asked me recently about what is succession planning. And I said, well, the best way to be prepared for succession planning is to have a really solidly run business.
Yeah.
You got a good business plan. You got a long-term prospect for the business. You're going to have options. So it's really, it sounds pretty simple. I know it isn't. But it's really just about being organized, having command of what you're doing, and being prepared.
Yeah, and that's going to drive us right into talking about really how to prepare. Some bullet points of really to write down. We want to give you some things that become action steps for you. But one thing before we leave the challenging piece is I often see equity requirements for your buyers as a challenge. Now, not all of your buyers are going to need financing, right? Some of you have cash buyers, and it's not an issue.
Right.
Most of you will experience buyers who need financing, and we see equity, as in the down payment for that loan, to be a big challenge.
Maybe explain that, because it is. You're right, Tim. I mean, we see this problem all the time. What is the equity, or what amount of money am I going to have to bring into a deal? So maybe expand a little bit on that, because it's a challenge that people come to the table thinking that they have the ability to buy something or finance it. But they come up a little bit short on the equity piece. Yeah.
For the purpose of this call, let's break it down into 3 categories. Let's break it down into your first-time buyer for your first business. Let's break it out into the buyer of your second or third business, so you already own one. And then let's break it down into more of your larger buying groups. Those are three pretty fair categories. So if you're a first-time buyer, you're working for the firm, and you have a chance to buy it, or you're going to buy another firm, typically you should plan on 10% equity. So if you're buying a $2 million funeral home, that's $200,000. And we recognize that not many of us just have $200,000 laying around. If you have a young family and you've been a funeral director, that can be a challenge. And that's common, right?
Sure.
In talking about planning, if you get in touch with us early, you talk to the owner, the seller, there are ways to accomplish that equity. There's seller carry options to start talking about, but that needs to start being a conversation between you and your seller early.
Is it fair to say nowadays, we like to, with a little bit of creativity, you can finance 100% of the purchase with a little bit of runway to get it done?
That's right. Yeah. Yeah. So for example, let's say that we talked to you early on and the seller is willing to give you, a couple shares of stock, and now you own 2% of the company. And you've owned that for a couple of years. Well, we might be able to justify 100% financing, right? And then maybe the seller is willing to hold the whole 10%. So technically, we're financing you 100% too. So
yeah, and I think that's one of those key points, though, in that succession planning. When we know that less than a quarter of owners have prepared themselves for that transition, is give us 12 months, give us 24 months, and there's all sorts of options of what we can do, right? And if you wanted to transition to somebody other than a third-party buyer, there's options, but you got to have a little bit of runway to do it. So give me 12 or 24 months, and we can almost put anybody into a position of ownership. And I say almost. Obviously there is credit concerns and other considerations. But the way that the SBA has put this together, there's really are some options to make this happen.
Yeah, and if you're a Category 2 and you own an existing business already, you can get 100% financing most likely because you own a business. And you might say, well, the SBA is not for me. I've grown past that. Well, you can be strategic, and use up the $5 million SBA runway first, and then graduate into more of a stronger conventional buying plan and really maximize from some of the long loan terms of the SBA note. And so, again, I think just being creative on that. And the SBA can keep a lot of liquidity in your pocket, right? So, and then if you Category 3, you own a handful of funeral homes and you're looking to grow, equity requirements shift to more of your, loan to values type conversation. But those are pretty common and pretty known and not really an issue for the seller. Whereas on the first 2 categories, the seller needs to be involved in that, and they can actually make that transition happen a little more smoothly. So just the topic and knowing that you need to talk about equity with your future buyer, if you know who they are, can help you kind of prevent a major challenge at the point of sale.
Yeah.
So Chris, what are some tips that you would give individuals on how to really prepare? So maybe some actionable steps that they can do to start to think about selling?
Again, not to be overly simplistic about it, but excuse me, but it's really be organized. And when I say be organized is make sure that you are staying on top of your financial information, your legal situation, your general operating results. And so all that really is to say is make sure that you have that you stay on top of the business part of running a funeral home or a cemetery. And that's what we find all too often in this business. You know, one of the things, we have the most wonderful professionals in the world, but all too often we don't focus on running our business, as you were talking about earlier. We focus on caring for families. And this is really where that focus on business and making sure that the financial statements are accurate. We understand them. We know what sort of activity is going on. Just having a general command of what's going on in your business, and it's really all facets, is the most important thing. I mean, we have a standard data request that we would use if we're going to engage with a client to get a better understanding. But most of us who've been in this profession for a while have a pretty good idea of what the important things are, and just make sure that you know what's going on. And unfortunately, I hate to report that it is terrifying what percentage of our ownership really doesn't have that level of understanding of their own businesses.
Yeah, I'll give you a real example of this. I was looking at a couple of transactions this week, and the first transaction came in with no financial add-backs, meaning that no expenses were identified that were going to be alleviated once the buyer purchased the business. So the seller had not provided any information about maybe hidden expenses or personal expenses that were obviously there. And by looking at the margins, I could tell that there was something missing, right? There was no way this business was operating at this low of a profit margin, right? Example number two, transaction came in a full 4 to 5 year history on financial expenses that were going to be alleviated, that were provided by the seller, and allowed me to get a really clear picture of the true cash flow.
Yeah.
My time in deciding on those two loans were drastically different.
Yeah.
And I'm talking weeks, if not months in some cases. We've seen some transitions take a year to go from initial due diligence to underwriting, because we're having to go back and have the seller chase down a lot of historical data, right?
Oh, yeah.
And so I would say, just for a few tips as an owner today, start tracking your expenses. And categorize those by which of those would go away if I sold today, which one were one time in nature, right? Hey, we repaired the roof this year. I'm going to make a note of that. And I'm going to make a note of how much it was and where it was shown in the tax returns by asking my accountant. Those kind of things is going to make your transaction move a lot faster. Even if a buyer doesn't need financing, the buyer is going to want to know that for themselves, regardless of the bank.
Well, I think the operative word that you use there is track. Just track. I mean, understand what's going on, and whether we can go off on rabbit trails all day long here, but when it comes down to it, being able to look and track apples to apples to apples, even if it's, I don't endorse bad information at all, but if you can at least have something constant, we at least know what those trends look like, and we're able to track.
Yeah, and look, I don't want to get too basic and assume that the listeners here don't understand this, but I do want to highlight what the goal is related to the financials, right? Let's simplify this. Yeah. The goal is to show the most amount of net income as possible in your business, number one. And
cash flow. Show the cash flow.
Cash flow, yeah. When I say net income, the most cash flow possible. Over time, you get your business operating efficiently, meaning lower expenses, growth in revenues, you're going to have more and more cash flow. Goal number one. And goal number two is to track, so you can make that cash flow look even better by identifying the expenses that are going to go away. And that is going to improve the valuation of your business. It's really that simple. And the problem is it's complicated due to a lack of information. I could only guess how long it takes Chris on average and his team to maybe collect some of this data? I know on loans that we're working with customers on the same type of situation, it takes us a while. On average, probably 60 to 90 days when there's not tracking involved. So can't hound on that enough, but I would say that's a pretty good start in terms of how to prepare.
Yeah, and I think tracking, knowing really it's really about knowing that command of your business. But a big part of this also, Tim, I think, and you've touched on it earlier, is what are your wishes, right? Where do you want this business to go into the future? Do you have people in your organization to sustain it? Mm-hmm. If it are people that you want to call it staff or family members, are you matriculating them up in the ranks of leadership and helping them grow into that position of being able to take that business over? I mean, I know one of the things that you all look at in your criteria is about the individual, right? I mean, that's a pretty important piece, is who you're going to be in business with.
Yeah, that's a really good point. We've been talking about the finances this whole time, but we haven't talked about probably what is most important to Live Oak outside of the finances, and that's the person, right? And so I think to your point, Chris, for us, I know when we're evaluating an opportunity, we're really looking at the situation of the staff, how much transition is going to take place there. We call that transition risk. So as a part of your succession plan, if you can minimize that risk, but that takes planning. I hear it all the time. I want to sell, but I don't know who I'm going to sell to. I mean, I don't have a person identified yet. And if you're a year out from wanting to retire and you haven't identified that you're probably a little late to the game. And not to say that you can't find a buyer. There are a lot of buyers out there who will relocate. And I'm not saying that. However, I will tell you that some of the most successful transitions we've seen are people that have been groomed internally to take over. And that's a really fruitful transaction. And it's an exciting one to see that intercompany transition. So, Chris, I think you hit the nail on the head. And I think that's probably actually one of the biggest barriers to succession when somebody is not selling to maybe a larger corporate entity, is that, smaller funeral home transaction or transition.
Right.
So
Tim, I think you on that point right there, on that smaller location, the smaller business that is transitioning over time, that's the one where that down payment, that equity, that's putting that person into business creates. You've created an opportunity that might not otherwise be there if it is a moment in time, right? Somebody has to sell the business or transition or whatever it may be. There's a scenario where you've limited your options.
Yeah. So one question I have for you, Chris, that people may want to ask is, hey, you know what? I do want to sell to a corporate. I do. That's my goal, and what I want to do, and that's okay. That's okay.
I think I shared this earlier, but of all the successions that we took place in, that we participated in last year, a little more than half of them did not go to the highest offer. So it wasn't all about the money. And obviously a lot of those, in some cases, there were consolidators and more of the national players were involved. They simply made a decision based on who they thought the owners made a decision based on who they thought the right stewards for their business going forward. And that's a big part of it. But it goes back to when you talk about those smaller businesses, that is going to be the logical buyer more and more often. It's going to be that individual. It's going to be a competitor. It's going to be somebody in the general vicinity if you don't groom them internally.
That's right. What are some of the corporates looking for that maybe some of the independent buyers may not be? What are some criteria that they're really looking for and prioritizing what they're buying and what they're not buying?
Well, I think each of the buyers have a slightly different investment thesis of what they're focusing on. Foundation Partners, for example, has had a very strong leaning towards a cremation forward business. Obviously, SCI has been around for the longest. They're really looking to bolt on to their existing businesses or other carriage trade franchise type businesses. Park Lawn has been doing a tremendous amount of acquiring, and they've been doing a really fine job at it. There's a lot of activity. There's a lot of good options out there right now. The transaction environment is still very active, but some of the things affecting it obviously are interest rates, the cost of doing business, some of the challenges that we're facing around staffing, inflation, all those things come into play. And so what we have seen is, while it's still a very good environment, particularly for some of those really well-run and well-planned businesses, it's that the valuations are coming down a little bit, right? So what we've seen, and we kind of saw a peak back in 2021, which you guys were certainly at the epicenter of, when interest rates were darn near nothing.
Yep.
And valuations in our space were probably about as high as they've been certainly in a long time, if ever. And we've seen those come back a little bit. So valuations have come back probably about 1 times multiple of EBITDA, so maybe about 15%, 20% in some cases. So it really depends. But that's, to your point very early on in this conversation, that's a big difference when you're looking at probably 80+% of your own personal net wealth tied up in your business.
Yes. And I think it goes back to, if you have a goal of selling to a larger company, or if you have a goal, you've got to align your business model to what their objectives potentially are. So, just like when you were starting your business, you've got to plan about who you're trying to transact with and try to align your business to be attractive to those individuals. So again, this keeps going back to your plan and to tracking, and are really pushing your business in the direction of where you want it to go. You can't just hope is not a strategy in this situation. And so understanding what objectives these larger companies are looking for may help you redesign your business. So I would tell you that there's nothing wrong with that, right? There's a lot of people who really promote independent transactions and love that, and that's totally fine. And they might be a bit less selective in terms of what they're buying, as long as cash flow is good. So when kind of moving on to talking about maximizing value, when we talk about maximizing the value of your business, we're really talking about strategies to get the most money at the point of sale. Mm-hmm. We kind of already hit on this a little bit related to, well, it's pretty simple. You show the most cash flow possible, then the multiple of that's going to be higher. So Chris, maybe share a little bit of the history. I know you just touched on that a little bit, but some of the history on multiples in your 30 years, give people some context of how that's changed and really what that means,
Yeah, and it's this great big phantom multiples of EBITDA, right? What does that mean? Everybody has their 2 cents worth as to what somebody got for their multiple, or what that really means. It comes down to, that is the metric probably most commonly used as a measure for what people are paying today. And what we saw is, we went back and we looked over the last 5 years at all of the transactions, all the valuations that we were a part of, and broke them down into really 3 different groups. And I say that we broke them down between businesses worth probably up to about $5 million, and then $5 to $10 million, and then more than $10 million. And what we did is we tracked all of the valuations over the last 5 years and currently. And what we've seen is that, I mentioned this earlier, but around 7 times EBITDA for a $5 million business, give or take. And we saw that fairly constant in 2019, 2020. It shot up to about 7.5 times in 2021. And we've seen that come down to about 7 times, back to about where it was pre-COVID numbers in 2022. And what we've seen this year in deals of that size is that they've come down to about 6.5 times. So that's where that 15 to 20% difference in value, on the high side has manifested itself. And that really is a product of, what does it cost to borrow money today? What does it cost to run my business tomorrow? Mm-hmm. And what are my expectations around that future opportunity? And that's really how those numbers are, that's how they've kind of evolved in the last 5 years. So I mean, it's really, to me, it's pretty telling because it kind of speaks to that relative uncertainty that you were talking about early on, which is, what do I do? What do I do? Well, if I thought my value was one thing and it's another, my investment portfolio looks like something entirely different, and my cost of retirement's an entirely different thing altogether. This is where we start to reevaluate, and we're sitting in that, and I guess in that state of flux, trying to make a decision as to what we're going to do.
Yeah, that's actually very in line to what we saw with multiples as well. And, if you would have asked me 8 years ago what our average SBA loan multiple was, it was probably 5.5 times, 5 to 5.5 times, 6 maybe.
Yep.
And then it got to 7, which was common. And then last year peaked to 7.5 to 8 in some cases. And then now we're trickling down because of rates. But it all is kind of a balance, right? You're paying less because you're paying a higher rate, or you're paying more because you're paying a lower rate. It's really all about the cash flow. And I think when owners and buyers really that clicks, it's less about the environment or the economic conditions, whether it's a high rate or low rate. Mm-hmm. It's really about the cash flow of the business. And if you understand your own cash flow, you're ahead of the curve, because you're going to be able to know where to make tweaks and changes to improve that. And you're going to know probably what to expect for your business. But if you're a buyer and you understand cash flow, you're probably going to make a pretty smart purchase. And you're going to be able to be, you're going to be able to be a part of the negotiation instead of just relying on everyone else to tell you what you should do, which those advisors, Chris, people like us, that's important to have. But it's also important for you to have a little bit of awareness on what that means for you in the business. And that's kind of what we're trying to bring your awareness around today. And if not all of you get the opportunity, like me and Chris, to spend most of our day talking and looking at EBITDAs and how to get them better. It's like anything else. Repetition is important there for it to really click. Reach out to us and let us walk you through one. I mean, we can walk through yours. We can look at your 3 or 4 year history and tell you what yours is and talk about what we think about it and give you some tips on that. That's a really good way to start to think about this as you kind of prepare for that future transaction.
One of the things that we see also, Tim, and I kind of like, and it's one of the things that we do in our ongoing consulting practice when we work with people strategically, is most of these people, certainly if they've been in business for some extended period of time, candidly, they don't have a whole lot of accountability. So, even just having some sort of a plan around it and talking about it and measuring yourself, that is a big part of making that improvement. And that's what we find more and more often, is when people do come to us and we're able to, I guess, open their eyes to some of the opportunities that exist in their own businesses. That's where they unleash a tremendous amount of value. Also potentially open up opportunities that they didn't think were there. I mean, you and I have worked on a number of things together where we've been able to get people into businesses that they thought they wouldn't have a prayer.
That's right.
Yep. I mean, there's nothing better than that.
Yep.
So it's really a cool thing to be able to do with a little bit of planning.
No, you're exactly right. I mean, there's tremendous opportunity. We really call it the American dream when we see a first-time buyer buy the funeral home they've worked for 20 years, or, go buy a neighboring community funeral home, and they go from making, your average funeral director salary to now having potential to really start their own legacy. And pretty awesome experience.
This is a bit of I say it's a quasi-loaded question because I'm going down that road of not knowing the exact answer here. Mm-hmm. But what's the success rate of people going into business for the first time? I mean, for you guys in your portfolio, you guys have been in the death care lending for quite a while. I mean, it is great. It's great opportunity for people when they get in it. By and large, they're pretty successful, aren't they?
Yeah, I mean, we've been in it since 2010. We're approaching $1 billion of transactions, and we've had less than a 1% default rate, and that's incredibly low, but that's also consistent with the industry statistics on default for funeral service. It's an incredible profession.
It's a great opportunity, man. That's the, and I think that's the coolest part about it. It's like, I know it's not quite, the math isn't that simple, but 99 out of 100 people in this are going to do really well in this new endeavor.
And here's the theme. It's simple. It's never the business. It's always the person. Okay. So, and I say that to say that, look, you're going to have to try to mess this business up. You're going to have to disconnect from it. You're going to have to not care for the family, not spend time with your staff, and not give any creative time to how you're going to improve it. But if you're doing those things, you're going to probably do pretty well. Sometimes we do see some low-cost providers pop into a market and disrupt the business plan of the owner. And, that creates a little downward pressure on your pricing, or wants to put downward pressure on your pricing. But there's ways to offset that. I personally think as a business owner, that is your accountability to some degree, because now they're forcing you to think about your business in a different way. And if you're not nimble and willing to adjust and adapt and pivot, then that's where you've really got to self-evaluate, right? And Chris, look, you're a business owner, right? And, how does that feel for you, right? You're constantly watching the marketplace, and you're constantly willing to make a pivot. One, if you see an opportunity, but also if you see an area of competition that you want to combat, you got to be aware enough and you got to watch. You can't be naive enough to think that it's never going to change, right? Maybe you could share your insight on that.
Well, I think that's it's a great point. It's about being self-aware. It's about engaging your customer, your client, understanding what you're doing well, what you're not doing so well. Mm-hmm. The engagement to me is a big part of that. And I think you're right. You have to always constantly be evaluating your marketplace. One of the things that we harp on or harping on much more these days than we may have done 5, 10 plus years ago is market share. A true measure when we look at the volatility in volume over the past couple of years. Probably the best measure we have right now is market share, is being able to have that level of awareness and acknowledging when there are soft spots in your plan, or when there's opportunities, or when there is a need missing in the marketplace. That's just about having your eyes and ears open. And that is one of the things that we all, we talk about working on your business versus working in your business. Mm-hmm. And all too often it is so easy, particularly in our profession, funeral profession, to get involved in your business, right? Serving families day in and day out, waiting on the people that come through the door, taking the phone calls, and you ignore the elephant in the room, which is the bigger entity, which is the entity, the business. It's the enterprise going forward, and we just don't spend enough time focusing on it.
Absolutely. You said a word there that I think is very important to unpack a little bit, and that's the word focus. At ICCFA, I actually talked about some characteristics of 100 successful CEOs and kind of unpack that a little bit. And I'm actually sharing that here soon in a couple of weeks again. But one of the themes was those individuals took time out of their day, of their week, to be creative. They gave some mental space to think about what is next for their business. Yeah. And I'll tell you, I was a small business owner. I raised my family for the first 15 years of my career as an entrepreneur. And I didn't get a W-2 paycheck. It was on me. And it depended on my relationships with my customers. And I laid in bed at night thinking about that next customer. And I thought about the competition constantly. But what was probably the most rewarding and helpful thing that I did during that time was oftentimes at night when things were quiet, I would sit down with a notepad and I would dream. And I would write down things, ideas. Matter of fact, an event that me and Chris are partnered on called the Suppliers. Part of those ideas came from that kind of time to where it's quiet. So just to give you a few tips as we kind of round this session out, Chris, I'll go first and I'll let you share some of yours just from your personal experience, maybe from your daily routine as a business owner, as a leader. Some tips that I would share, I would encourage you is give yourself some time, some quiet time to think about areas that you need to either pivot or the next big thing for you in your business. Take those opportunities in that quiet space to question what you're doing and feel okay about it. Think about your competition, but just give yourself the opportunity. Oftentimes as an entrepreneur, there's enough in the day to keep you busy to where you never make that space. I know what that feels like. I've been there. And matter of fact, even in this role today, I could spend 12 hours a day looking at financials and never think about a plan or a goal. So I would just encourage you to pause, take a second, think about where you are, make a list of things you need to start incorporating into your routine. And I think that time alone can make a pretty big difference in your business.
No, I think, Tim, I think you said it very well. I think a big piece of that is routine, is establishing what that routine is. And, it's not easy being a business owner. It's not, you touched on it. We get things thrown at us all day, every day, right? So I mean, it is hard to stay focused to that point, and to have that plan, know exactly how you're going to tackle the day, the week, the month, the year. Your business plan is critical to me. I'm a big fan of quotes. Nicole kind of laughs about it, but I always work in a quote here and there. But it's one of Warren Buffett's quotes. He would take an idiot with a plan over a genius without one any day, right? At the end of the day, if you've got something to measure, something to stick to, keep you focused on where you're going, I like the chances a heck of a lot better than not. So for me personally, a lot of that has to do with being able to stay level too. It's put that plan in place. Know that the best laid plans are only as good as until the first shot is fired, so to speak. So so once we go to war, right, it's all hands on deck. And the best you can do is be as prepared as you are, have the best people you can around you with the right culture, doing the right things. It's consistency that wins. It's, there's all too often in society today, we're looking for that one hit wonder. And succession planning, funeral service, it's about consistency. It's about the long term. Same thing is you as a leader, you as an individual. To me, it is about being consistent and consistently improving. I can go through, I can dive into statistics all day long, but it's about being consistent and just doing a little bit better each and every day.
Absolutely. That's so key. And I think that finding that routine, being consistent in that routine, and a part of that routine involving planning and organizing for your business. I'll tell you, somebody that's doing that can do a lot of damage in a quarter, and that impact on your business, believe me, you might be saying, well, I'm actually picking up a quarter of our calls a year. I'm actually meeting with the families, and you may be a small funeral home and doing that, and that's awesome. You may need to do that. But if you don't need to do that and you're doing it because you like it, make sure you make some time for the business too. And that's okay. And I think you'll find it very beneficial. So kind of as we round this out, we really appreciate your time. We hope that you have found this to be valuable to you and your business. But if you have specific questions, feel free to contact me or Chris. Chris, why don't you share your email address verbally, and then they'll follow up with it as well.
So my email address is CRUGER at theforesightcompanies.com. So CRUGER at theforesightcompanies.com. So if you can't hop on our website, please reach out to me. I do see a couple of questions on here. Please feel free to reach out to me directly, and I'm happy to answer those, or I can answer them now. Tim, you tell me if we have time.
Yeah, we do.
Okay. I see a question in here from Salvatore about a pre-need book of business and why aren't they looking or giving me value for it? The simple answer is that that value is baked into your current financial numbers. And I'm happy to walk through an example with you on that. But when you look at your current at-need business, presumably a pretty significant portion of that is your pre-need business turning at-need. So when you look at your at-need business, typically we would see something in the neighborhood of 25 to 30% of the at-need volume is coming out of the back-need, or excuse me, out of the backlog of the pre-need. So that's where it's being taken account into the cash flow or that EBITDA number. And the other way that it would ultimately or should be being taken into account in your valuation would be around the multiple, right? So if you have a very large backlog of pre-need, that should speak well towards the future, should increase the value, and should have some added value in the multiple that you're receiving in those numbers. So it's really in two places, but you should be getting that value in those numbers, but not knowing the situation. That's about all I can say.
Yeah, we actually look at it the same way. You know, Chris, we don't really give quote unquote cash flow credit for the pre-need, but there's a huge intrinsic value to a strong pre-need book, and it's the part that obviously we know some of that's going to be converting to at-need.
Yeah, you take Salvatore's situation here. If you took whatever's coming out of that backlog, took that out of your current at-need numbers, I mean, that would be a radically different financial statement and situation on its own, right? So, I mean, if you were to just take that out and isolate it, it just complicates things. So you're right. It's in the intrinsic value that we're seeing.
Yeah. And thank you, Salvador, for the question. And Chris, feel free to post your email in there and website if you have questions. And if any of other of you have questions, want to ask, shoot us an email. We'd be happy to help you walk through it. And if you happen to be coming to any of the events around the profession, make sure you stop and say hello. Chris, really valuable time. Thank you for taking the time to speak with us, and look forward to seeing you around soon.
Tim, really appreciate it again. Thank you all and ICCFA for the opportunity to be on this. It is such a important topic right now with what we're facing as a profession. So the more that we're able to talk about this, get more people involved in the process, into your pipeline, working with us, we love the opportunity, and we're very grateful to be here.
Great. You'll have a good day. See you soon.
Thanks.
Bye-bye.